Billionaires pay lower tax rates than teachers, not because of offshore accounts, not because of illegal schemes cooked up in the Cayman Islands, because of three completely legal words that a law professor invented in the 1990s to explain why the tax system is fundamentally broken. Buy, borrow, die. Once you understand how this works, you will never look at wealth, taxes, or the financial news the same way again, because the conversation everyone is having about taxing the rich completely misses the point. You cannot tax income that never gets realized, and the ultra-wealthy have spent decades making sure they never realize any. Let's break this down. Why rich people think about money differently. Most people build wealth the same way. You go to work, you earn a salary. The government immediately takes income tax, payroll tax, Medicare tax, and whatever your state wants before you see a single dollar. Then you save what remains and try to build something from the leftovers. The wealthy flip this sequence entirely. Instead of earning income that gets taxed immediately, they buy assets that appreciate silently in the background. Growth stocks that pay no dividends, real estate that increases in value, private company shares, art, things that grow without triggering any tax obligation whatsoever. Here is the critical insight. In America, you only pay capital gains tax when you sell an asset, not when it grows, not when it doubles, not when it turns 1 million into 10 million, only when you sell. So the first move is elegantly simple. Buy appreciating assets, never sell them, watch your net worth climb for decades while the IRS sits on the sidelines, unable to collect a single dollar. This is the buy phase, and by itself it is powerful. But the obvious problem is you cannot pay for groceries with unrealized gains. You cannot fund a lifestyle with stock certificates. So how do you actually access that wealth without selling and triggering taxes? This is where the strategy becomes genuinely extraordinary. The borrow phase, where the magic lives. Once you have substantial appreciating assets, you use them as collateral to borrow money from a bank. This is called a securities-based line of credit, and major financial institutions have built entire divisions specifically to offer this product to wealthy clients. Here is the part that changes everything. The government does not tax borrowed money, full stop. If you borrow $1 million against your stock portfolio, that $1 million flows into your bank account completely tax-free. You can buy houses, cars, businesses, fund any lifestyle you want. The IRS treats it as if it does not exist because technically it is debt, not income. The terms on these loans are favorable in ways that will frustrate you. Wealthy borrowers with large portfolios can access loans at interest rates between 2 and 6% annually. Banks will typically lend 60 to 80% of portfolio value. Someone with a $10 million portfolio can borrow $6 to $8 million at low interest rates against assets they never have to sell. But here is where the math becomes almost unfair. While you are borrowing against your assets, those assets continue growing. If your portfolio earns 8% annually and you're paying 5% interest on your loan, you're still 3% ahead. Your wealth keeps compounding, your lifestyle gets funded, and your tax bill for the year is zero. This creates a cycle that can theoretically run indefinitely. Assets appreciate, borrowing capacity increases, you take out larger loans or refinance existing ones at better rates, your wealth grows faster than your debt, you live entirely on borrowed money while your actual net worth climbs in the background untouched. Let me show you what this looks like with real numbers. Maria's million. Maria sells a business and walks away with $1 million. She invests it in a diversified portfolio of growth assets, averaging 7% annually. After 10 years, she has nearly $2 million, a gain of $1 million that has never once been touched by taxes. If she sold those assets, she would face capital gains taxes, net investment income taxes, and state taxes, potentially consuming $250,000 or more of her gain. She does not sell. Instead, she walks into her private bank and borrows $1.4 million against her $2 million portfolio. At 6% annual interest, that costs her $84,000 per year in interest payments. Compare that to the $250,000 tax bill she avoided. She's paying a smaller ongoing cost to access her wealth instead of a massive one-time cost that permanently destroys a quarter of her gains. Meanwhile, her portfolio keeps growing. At 8% annual return, her $2 million generates $160,000 in growth per year. She pays $84,000 in interest and nets $76,000 annually in actual wealth accumulation, while simultaneously living on $1.4 million in borrowed funds. She's getting paid to borrow money. Her wealth grows faster than her debt, and her annual tax bill is essentially zero. But what about when the loans come due? This is the question everyone asks. It's also the question that leads to the third and most infuriating part of the strategy. The loans do not need to be repaid until Maria dies, and when she dies, everything resets in a way that should make anyone who's ever paid taxes feel something between amazement and genuine rage. Under current American tax law, when you inherit assets, you receive them at their current market value, not at what the original owner paid, not at the price 30 years ago, at today's price. All the capital gains that accumulated over decades simply disappear for tax purposes. This is called stepped-up basis, and it's the legal mechanism that makes the buy, borrow, die strategy complete. If Maria's grandmother bought stock for $10 a share 50 years ago, and it's worth $500 when she dies, her heirs inherit it as if she paid $500. Every dollar of appreciation between $10 and $500 becomes permanently tax-free. The government will never collect a single cent on those gains. So here's what happens when Maria eventually dies. Her heirs inherit her portfolio at her current market value. They can immediately sell enough assets to pay off all outstanding loans and owe zero in capital gains taxes on the sale because the stepped-up basis eliminated all the gains. Whatever remains after paying the loans becomes their tax-free inheritance. Maria started with $1 million, lived lavishly on borrowed money for 30 years, watched her portfolio grow to $8 million through uninterrupted compounding, accumulated several million dollars in outstanding loans. Her heirs sell $4 million to pay the debt, keep $4 million completely tax-free. Total tax paid on the entire transaction across 30 years of wealth accumulation? Essentially zero. Why this conversation matters. In 2021, ProPublica obtained leaked IRS data showing that the wealthiest Americans paid effective tax rates that in some cases were lower than 1% of their actual wealth growth. This was not because of illegal activity, it was because of exactly this mechanism. You can raise capital gains tax rates to 90% tomorrow, and it changes nothing for someone using this strategy because they never realize capital gains. Politicians debate tax rates endlessly, while the ultra-wealthy shrug because tax rates are irrelevant when you never sell anything. The teacher paying 30% of her income in combined federal and state taxes is playing a different game than the billionaire whose net worth grew by $500 million last year and whose tax bill was calculated on income of $23 million they chose to take. Warren Buffett famously pointed out that he pays a lower effective tax rate than his secretary. This is exactly why. His secretary earns ordinary income, he holds appreciating assets and borrows against them. If this is pulling back the curtain on something you needed to understand and you want this kind of breakdown every single day, hit subscribe. Back to it. What this means for everyone else. Understanding buy, borrow, die changes how you think about several things simultaneously. It explains why wealth inequality keeps growing despite periodic political conversations about taxing the rich. You cannot tax wealth that never gets converted into income. The mechanism itself is the protection. It explains why the wealthiest investors never seem to sell during market downturns that terrify everyone else. They're not planning to sell ever. Temporary market drops are irrelevant to a strategy built on never realizing gains.
It explains why major financial institutions have quietly built entire lending divisions specifically for high net worth clients. Securities-based lending is not a niche product. It's a massive industry that exists specifically to facilitate this cycle. And it explains the stepped-up basis debate you occasionally see in political news. Every few years, someone proposes eliminating stepped-up basis, which would close the die portion of this strategy. Every time, it fails. The lobbying power of people who benefit from this mechanism is substantial. Can anyone else use this? Partially. And understanding the partial version matters even if you're not working with millions. The core principle of buying appreciating assets and avoiding non-necessary taxable events is accessible at any wealth level.
Holding index funds and tax-advantaged accounts, avoiding frequent trading that triggers capital gains, and letting compound growth run uninterrupted are all versions of the same underlying logic applied at smaller scale. The borrow against assets component becomes meaningful at roughly 1 million in investable assets for most institutions. Below that threshold, the mechanics do not work as cleanly. The die phase with stepped-up basis is available to everyone, but most powerful when applied to substantial appreciated assets. The full three-phase strategy in its most powerful form requires significant capital to execute. This is not an accident. The system was designed in an era when the people designing it had significant capital. The bottom line: the buy, borrow, die strategy is not a loophole. It is not a technicality. It is not an obscure scheme most wealthy people do not know about. It is the operating manual for generational wealth preservation in America, used openly and legally by the people who can afford the financial advisors who explain it to them. You earn income, it gets taxed immediately. They accumulate wealth, it grows untaxed. They borrow against it tax-free. They die, their heirs reset the basis. Repeat for generations. The game was always being played this way. You were just never told the rules. Now you know them.